Somewhere in the developed world right now, a central bank is adjusting interest rate policy. Artificial intelligence is eliminating job categories that existed 6 months ago, and residential real estate prices continue to climb further from what a median income can reach. Against this backdrop, millions of working professionals are doing something that feels rational, but is, by the math, one of the most expensive decisions they will ever make. They are waiting. Consider a mid-career professional working in operations management at a mid-size logistics firm. She earns a respectable salary and carries several $1,000s in credit card debt. She has no brokerage account, no retirement contributions beyond what was automatically enrolled years ago at a previous employer. She is not financially reckless. She is financially frozen. And the distance between those two things is where most of the damage happens. She holds a belief shared by a staggering number of professionals in her position, that wealth building is a closed game, reserved for people who already have capital, that you need money to make money, and until some windfall arrives, an inheritance, a promotion, a lucky break, the rational move is to wait for a better moment. The financial media reinforces this. Every headline about market volatility or recession risk provides another reason to defer. And so another year passes, and another. But the historical record tells a fundamentally different story. Nearly every generation has faced a moment that felt like the worst possible time to start investing. The stagflation of the 1970s, the crash of 1987, the dot-com collapse, the global financial crisis. And nearly every time, the individuals who began anyway, methodically, without speculation, outperformed those who waited for clarity that never arrived. The pattern is not motivational, it is mathematical. And it operates on a logic most people never examine closely enough to see. What that pattern reveals is a sequential structure, not a single decision, but a series of phases that build on one another. A foundation, an engine, a tax shield, and a portfolio. Each phase addresses a specific financial vulnerability, and skipping ahead tends to produce exactly the kind of fragile structure that collapses under the first unexpected expense. If you find value in this kind of long-form economic analysis, the sort that replaces noise with structure, consider subscribing. It is the simplest way to ensure each new installment reaches you directly. The first phase is the one almost everyone wants to skip, and it has nothing to do with investing. It has to do with debt. When most people say they are starting at zero, they are being optimistic. Consumer debt, credit cards, personal loans, buy now, pay later balances means the actual starting position is negative. And negative is not neutral. It is actively working against you with the same compounding force that, pointed in the other direction, builds wealth. There is a persistent idea in retail finance communities that you can outinvest your liabilities. The logic seems reasonable on the surface, but consider the arithmetic. A credit card balance at 24% annual interest, serviced with minimum payments, will cost roughly double the original balance over its lifetime. Every month, income is consumed not by living expenses or wealth building, but by servicing past consumption. Eliminating that obligation produces the functional equivalent of a guaranteed return at that same rate, a figure unavailable in any legitimate investment market. The protocol is mechanical. List every liability. Rank by interest rate, highest first. Direct all discretionary cash flow at the top balance while maintaining minimums on the rest. Audit subscriptions. Liquidate non-essential assets. The objective is velocity, not comfort. And once the high-interest debt clears, the freed cash flow does not become spending money. It becomes fuel. The instinct after clearing debt is immediate. Open a brokerage account and start buying. But this instinct, acted on prematurely, is statistically the most common reason new investors fail within their first 18 months. The failure mechanism is straightforward. Life generates irregular, unavoidable expenses. Vehicle repairs, medical costs, temporary unemployment. If all available capital is deployed in equities, and one of these events coincides with a market downturn, the investor is forced to sell holdings at a loss to cover the expense. The compounding chain is broken. The loss is permanent. Picture two investors entering the same year with identical portfolios. Both experience a 20% market correction, a normal event that has occurred every few years across the last century. Both then face an unexpected job loss. One has no cash reserves and must liquidate at depressed prices. The paper loss becomes real, and recovery requires the market to rise substantially just to return to the starting position, while the investor no longer holds shares to benefit. The other maintains several months of essential expenses in a high-yield savings account. The portfolio stays untouched. When the market recovers, this investor participates fully. Over a 30-year horizon, that single difference can represent hundreds of thousands of dollars in terminal wealth. There is a popular narrative, often repeated on social media, that holding cash is irrational because inflation erodes purchasing power. This is technically true, but contextually misleading. A liquidity buffer is not an investment. It is insurance. Evaluating it by its return is like criticizing a fire extinguisher for not appreciating in value. Its purpose is to prevent catastrophic loss elsewhere in the system. With debt cleared and a buffer funded, the question of what to invest in naturally arises. But before asset selection comes a decision most beginning investors skip entirely, and it is arguably the most consequential one they will make. It is account selection. The default action is to download a trading application and begin purchasing securities. By default, this places assets into a standard taxable brokerage account. The account functions, but it offers no protection from tax drag, and over decades, tax drag quietly destroys more wealth than most people realize. The arithmetic is instructive. Consider capital that grows tenfold over 30 years. In a taxable account, the gain is subject to capital gains tax at withdrawal, potentially surrendering a significant portion of the growth. In a tax-advantaged account, like a Roth IRA, assuming eligibility and holding period rules are met, the same withdrawal can be entirely tax-free. The difference is not a function of better stock picks. It is entirely a function of which account held the assets. The sequencing matters. First, contribute to an employer-sponsored retirement plan up to the full employer match. That match represents an immediate return on contributed capital that no market investment replicates. Second, fund a Roth IRA to the annual maximum. Third, if eligible, maximize contributions to a health savings account, which carries a rare triple tax advantage. Then, return to the employer plan and contribute up to the annual limit. Only after these vehicles are funded should capital flow into a standard taxable account. The deeper function of this structure, beyond tax efficiency, is behavioral. Withdrawal restrictions create a natural barrier against impulsive decisions, the kind of short-term thinking that historically erodes long-term wealth. If you have followed this framework to this point and found value in the analytical approach, subscribing is a straightforward way to ensure continuity. Every piece of content on this channel follows the same standard: evidence first, conclusions second. Now comes the question everyone wants to start with: what to buy? The gravitational pull at this stage is towards stock selection, finding the next high-growth company before the broader market catches on. In the current environment, this temptation is amplified by artificial intelligence tools promising algorithmic edges and data-driven picks. The marketing will be persuasive. The underlying economics remain unchanged. The most comprehensive data available on active versus passive management, published regularly by major index research organizations, consistently shows that over extended measurement periods, the vast majority of professionally managed funds underperform their benchmark index. These are funds run by credentialed analysts with institutional-grade research infrastructure. If that level of resource allocation cannot reliably beat the index, the probability of a part-time retail investor doing so is statistically negligible. The alternative is index investing, purchasing a low-cost fund that holds the entire market rather than attempting to identify individual winners. The framework here follows a core satellite structure. The vast majority of investable capital goes into broad, diversified, low-cost index funds, automated through recurring purchases and never actively traded. The remaining allocation, strictly limited, is reserved for discretionary positions. If it goes to zero, the financial plan remains intact. If it outperforms, the gains are a bonus. This is not merely a portfolio strategy, it is behavioral architecture, a controlled outlet for the human impulse toward active participation, protecting the bulk of capital from the decision-making errors that impulse tends to generate. Every phase of this framework operates as a function of cash flow. Debt elimination speed depends on it, buffer accumulation depends on it, contribution capacity depends on it, and unlike expenses, which have a natural floor, income has no structural ceiling. There is a well-known concept in personal finance circles about the power of cutting small, discretionary expenses. While the compound math is valid, the practical magnitude is limited. By contrast, a single career advancement, a promotion, a lateral move to a higher-paying employer, the acquisition of a specialized skill, can increase annual income on a recurring basis by a factor that dwarfs any latte savings. The protocol is a skill audit. Identify the single competency in your current field that, if developed to a high level, would make your professional contribution significantly more valuable. Dedicate consistent daily time to structured development. The objective is not marginal side income, it is increasing the earning power of the primary income source that funds every other component of this system. A higher savings rate applied to a higher income compounds across every optimization discussed here. The arithmetic is inescapable. The operations manager we met at the beginning does not need a stock tip. She does not need a market prediction. She needs a sequence. Clear the debt, build the buffer, open the right accounts in the right order, automate into broad index funds, and invest in the skill that raises her income ceiling. None of this is exciting. None of it is novel. That is precisely why it works. If this framework has offered useful structure for your own financial thinking, sharing your perspective in the comments strengthens the analysis for everyone who encounters this content. Alternative approaches, constructive disagreements, and edge cases are all valuable. The path from zero to the first major milestone is the hardest segment. The compounding curve is flattest at the beginning, and the behavioral demands, patience, consistency, delayed gratification, are highest when the balance is smallest. But the mathematics do not negotiate. Time in the market, not timing the market, remains the dominant variable. And the most expensive year to begin is always the one that already passed. If this channel has earned a place in your financial research process, subscribing ensures each new analysis reaches you directly. The objective here remains the same: the highest analytical value per minute of your attention. Thank you for your time.